Hello, it's Rhonda Thomas, and we're about to do Financial Accounting's Chapter 12 coursework, which has to do with equities and mainly selling stock, dividends, treasury stock, and how to report on the stockholders' equity. So let's go ahead and get into it. We have two big problems to do, or two bigger problems to do to finish up this chapter. Okay, so I am going to there. Okay, there's two problems. All right, we have 2A blank sheet, 3A blank sheet. These are stock transactions for corporate expansion. I have highlighted all of my options here and stacked them. So I have some T accounts here to get started. So on December 1st, so let's go ahead and put down that it is December 1st of the current year. The following accounts and their balances appear in the ledger. Okay, so December 1st. All right, it says we have preferred stock. Now, when they talk about a stock, you want to put the information about each of those above the T account where it's located so you can keep track of what's going on. So it looks to me like this is 2%. Okay, so let me fill this in. So we're starting with 84,000 shares issued. That's the number that has been sold. Okay, I'm going to start 84 shares issued. Issued means to sell. Okay, and they have a par of $50. So $50 par. Okay, and they have 2%. Okay, 2%. Let me move this up. Might need a little more room here. Yeah. Okay, so they have a 2% dividend. And that what you have to think about then is 2% times par. Ooh, what's that? Okay, 2% times par is the dividend. Dividends per share. So 2% times $50. Okay, so that is equals 50 times 0.02. So that is $1 dividends per share. Okay, that, remember, preferred shares are preferred to getting their dividends first. Okay, now I'm going to put the balance in here. It's kind of a big number. So 4,200,000 is in preferred stock. Okay, now paid in capital that goes with preferred is right here. So the balance is 672,000. Okay, now let's look at common stock. Common stock usually doesn't have so much information about it. Once again, this is December 1st. So let me make just a couple more things here. Okay. So sometimes you got to have a place to put notes down so that you don't forget what's going on. All right, so then this common stock has 387,000 issued. Okay, okay, so I'm going to put that right here, 387,000 shares issued. Okay, that's how many they've sold. because we're going to have to keep track of how many shares. Okay, and just for kicks, I'm going to go back and put how many are authorized. But authorized is the number that they can sell. The amount of issued is how many they have sold. So however many you're authorized on your charter, okay, that you have to amend your charter if you want to sell more shares than that. Yeah. All right. So we'll go ahead and put the number we're authorized to sell in common, 1 million shares. Okay. And the par of the common is $35. Usually par for common is less than the par for the preferred because preferred is more sought after because they have basically they have a guaranteed dividend. Okay, so I am going to put this in yellow to help us remember that. Okay, and now we're going to put our balances in for common stock. Oh, par. Okay, so par is 35. Okay, all right, so it looks like common stock we have 13,545,000. And then the paid in capital in excess of par. So they were able to sell some shares in excess of par, which is more than $35 a share. Okay, there's that. Now, just for interest's sake, if you take this balance and divide by 35, you should get 387,000. I'm going to test it. I'm going to divide it by 35. Yep. So the reason we keep par in the account is to keep track of how many shares we have sold. So likewise over here, you should be able to take the 4.2 million and divide by 50 and you get 84,000 shares. So I just wanted to prove that to you. And by the way, over here, we're going to keep track of the number of shares outstanding. Okay, you say, what's the difference between outstanding and issued? Well, right now there isn't a difference, but I will explain it to you when we get there. So common shares is 387,000. Okay, and then the beginning preferred shares is 84,000. You do want to put that down, okay, because sooner or later we're going to figure out dividends. Okay, we have retained earnings too. So retained earnings balance 197,720,000. Wow, it's a lot of money. Okay, at the annual stockholders meeting now, it's now March 31st. Okay, so this was the balance, beginning balances. Okay, so then the stockholders meeting was on the 31st of the next year. So March 31st. Oops. Oops. Okay, at the annual stockholders meeting on March 31st, the board of directors presented a plan for modernizing and expanding plant operations at a cost of approximately $11 million. The plan provided that a building valued at $3,460,000 and the land on which it's located valued at $1,423,000 be acquired in accordance with preliminary negotiations by the issuance of 128,500 shares of common stock. So they're going to sell that many more, right? It says that 39,100 shares of the unissued preferred stock be issued through an underwriter. and that the corporation borrow 3,800,000. The plan was approved by the stockholders and accomplished by the following transactions. Okay, so we have May 11th. And I'm going to bring this down here because we've got to do some calculations before. So this is going to be May 11th here. Okay, so they're going to issue or sell more common stock. Okay, so let's figure this out. 128,500 shares of common stock. Okay, and that's in exchange for the land, a building, according to the plan. Okay, well, all right, so remember the par is 50. Okay, so let me see here. The land and the building. Okay, so what's going to happen is okay, so I'm going to have to change the names of a couple of these, and that's fine. Okay, so it looks to me like you just get these out of here. Okay, so okay, so this is not going to change anything. All right, so this is May 11th. So we're selling this, and what are we getting in exchange for it? So just ignore this stuff down here. This is notes from another problem. So remember, our par is $50. Yep. Okay, so just for the heck of it, I want to see how much that totals. Okay. All right. So they said that so one more time, we're getting land and a building according to the plan. So the land, no, the building is 3,460,000. So let's put the building here. Okay. Let's get the building here. So the building is 3,460,000. Okay. Yep. And then we're getting land. So I'm going to go ahead and put this in the T account so that we can work that. And then the land is 1,423,000. Okay, when these come in as debits, then we're going to offset. Okay, and this is going to be 5-11. Okay, so this is the May 11th. May 11th. There. That's the land. That's the building. Okay, and then we need an amount that goes in here. And so what we're going to do, we're going to add up those two numbers of the land and the building. Okay. All right. So we're looking at, what did I say? Okay. 128,500 shares of stock times $50. That's 6,425,000. Okay. Okay. So we're, like I said, for the issuance of common stock. Nope, common stock is $35. Sorry about that. I misread and tried to put preferred. Okay, let me do my figure again. I was going to say that's not all right. So 4,497,500 is the value of par. I need to add the building and the, all right, so we've got the building and the land, and I need to add those together. So the building is 3,460,000. And the land is 1,423,000. Okay, I need to add those two together because you can. All right, so here's what we've got. Here's the value of both of those. Here's the value of our common stock of its par. Okay, and notice this is a little larger than this, right? So we're going to, we've got these already in place. And so now we need to put in how much common stock is going to be. And once again, it's $35 par. So we're going to add 128,500 times 35 is right there. Okay. And that is less than the two together. So then we need to add the building and the land together, and then subtract the amount we just put here in common stock, because the rest of this will be paid in capital in excess of par. So there it is. That's the excess. So if you're not going to get cash, then you need to figure out how much the par is for the common stock. And then if when the assets are more than that, then the rest goes there. So let's see what happens when it comes to this journal. Okay, so this is May 5th. Okay, and we want, okay, so let me move this over. And once again, if I add up these together, okay, there it is, there it is. The excess, paid in capital in excess of par, paid in capital excess of par. So we're proving our calculation here equals this minus this. There it is. Okay, so there we are proving it again. All right, so the first one is the building. Okay, the building is 3,460,000. We're getting the land. Okay, 1,423,000. And then the credit goes to common stock for the par, right? The par of common stock up here. Yes, it's right here. Okay, it is the 128,500 shares at 35. So then you 4,497,500, and then common stock paid in capital. Here it is. Just copy it, bring it down. So that is a transaction that didn't involve cash, but we still allowed an investment in our business by getting the land and the building in exchange for ownership. Okay, so then the next one is going to be May 20th. Okay, let's check if we're right. Hopefully so. Okay, it's not checking it for us until we put in the rest. All right, so then May 20th. Okay, and we'll go back up here. So May 20th, we're issuing 39,100 shares of preferred stock receiving $51 per share in cash. Okay, so now it is May 20th, selling 39,100 shares of preferred stock, right? And their share price is $51. Okay, so we'll take 39,100 times $51 here. Okay, there's that. And then now we need to break it down between its par and its excess of par for these preferred shares. So par is 50. So we basically want that to come down here. Okay, so then it's 39,100 shares at 50. Okay, that's going to be the credit to the preferred stock. Okay, so I'm going to take equals 39,100 times 50. Okay, there's how much. And then the rest is the excess, which is the $1. Okay, so $1. And we want that to be times 1. So I believe the difference is 39,100. So this is all the amounts that we're going to do our these are all the amounts we're going to do the journal entry for. And I'll put that in dollars. So all right. Okay, so let's go ahead and put in May 20th. So what are we getting? We're getting cash. So I've got the cash amount, and this is preferred stock. Okay, so preferred stock. This is 5-20. Okay, so the cash is coming in for the full amount, which is the $1,994,100. Okay, and then preferred is over here. So then this becomes the amount down here of $1,955,000. And this is on May, so this is 5/20. Okay, and then the paid in capital in excess of par is right here. Okay, so the extra is the 39,100, I believe. 39,100, yes. And by the way, just so that I can check it, if I add up these two, yes, they do add up to this right here. Yep, got to check that every once in a while. Okay, so we're going to get cash. Okay, I didn't finish. So now we want the $39,100. This is also going to be 5/20. So that is booking this sale. Okay, so we're looking at cash of 1,994,100, and we're looking at preferred stock, all right, of 1,000,000. Here it is, 1,955,000. And then the preferred paid in capital in excess of par preferred stock. Okay, so the amount that it went over the par, that's what the excess is talking about. it is 39,100. So I believe that should be okay. And then, wow, okay, the last entry, borrowed, okay, borrowed 3,800,000 from Laurel National, giving a 4% mortgage note. Okay, so let me add a couple things here. All right, so now we want to, we're going to get cash. So this is going to be the borrowing. So it's 531. So you just put in the amount we're borrowing, 3,800,000. Okay, and then we'll do a note payable, mortgage note payable. Let's see what they, notes payable. Okay, but you could, I am going to put notes payable, and I'm going to put who it's with, because that is the Laurel National. So we know Laurel National. I don't think we're doing anything else with this, but all right, so then 3,800,000, not 38 million, sorry, one too many zeros. Now I'm going to put that this is a 4% note. Okay, but I don't know how long it is. It didn't say. So anyway, this should be it for these 3 journal entries. Okay, so this is, right, the cash came in for 3,800,000. So they can make this expansion, and then we're going to have notes payable of 3,800,000. Okay, so I think we've got it. Let's see if it's true. Okay, not May 5th. Thought it, no, May 11th. My fault. May 11th. Sorry about that. Okay, let me go back and look. Oh, mortgage note payable. Sorry about that. Okay, mortgage note payable. All right, so my brain was thinking that too. So we make this a little bigger. Okay, so once we get that fixed, I think we're okay. So mortgage note payable. Oop. Mortgage, what does this say? Mortgage note payable. Let me see if there's anything else. Okay. Mortgage note payable. Why is that still red? Let's try it again. I guess I forgot to put the extra G there. I think this is right now. Okay, so that is those 3 entries. And that's all we had to do for this one. All right, so now we're going to do another one that's a little bit more to it. And we'll stack these and see what we can do here. Okay, so now I'm down here for 3A. All right, it says the following accounts appeared in the ledger for parks construction at the beginning of the current year. So they have preferred and common and retained. So we're kind of fill in these just like we did before. So let me put a little room here, insert, so that we have, because I do think we've got dividends going on here, and we got treasury stock going on. So let's walk through this. Okay. All right. This is the beginning of the current year. So they didn't tell us what month it is. Okay, let's start with our preferred. Our preferred and I'm going to wipe this out from up here. Excuse me. Excuse me. Excuse me. Oh my goodness. Okay. So preferred, we have how many shares? It looks like we have 82,000 shares issued. So I'm just going to put them all up here. 119,000 shares authorized. That's from the charter. They have sold 82,000 shares issued. Okay, so we want 82,000 here. Okay, this is the par. The par is $70 and it's a 1% stock. Okay, the par is $70. Okay, and 1% times the par gives us the amount of their dividend. Okay, so if you take 70 times 1%, you get 70 cents. Okay, is that correct? 1%. Okay, all right, so we want that in dollars. So this is saying that dividends per share, 70 cents. Now, let's put the beginning amount of preferred shares. Now we're ready to do common. And remember, here's the paid in capital for, and so I am going to put in the balance, right? So the balance of the preferred 1% $70 par stock with 82,000 shares issued is 5,740,000. So we've got that in there. And then the balance in the paid in capital in excess of par is 155,800. Okay, let's go to the common now. How many are authorized? Okay, so authorized, quite a few, more than, yeah, all right. 4,950,000 authorized shares. So it's good to know the difference between authorized and issued and outstanding. And I will explain outstanding here in a minute. Okay, we've got 3,950,000 issued. Okay, that's how much has been sold. And the par for common is $5. $5 par. And there is no dividend. Now, this isn't a guaranteed dividend over here. This is not guaranteed. It'd have to say cumulative for it to be a guaranteed dividend, but it doesn't say that. But when dividends go out, they're supposed to be 70 cents per share issued, per share outstanding going out, and they get in line for theirs first. All right, so now I'm going to put the balances in. So the balance for common stock is 19,750,000. And then it's paid in capital in excess of par that goes along with it, 2,765,000. We come down here to retained earnings. Okay, retained earnings should be down here. And we're going to put in an amount. Okay, so I'm gonna get rid of that. All right, so let's put a retained earnings amount here, 34,910,000. Okay, and then I'm gonna get rid of that. Okay, so here's what we're starting with. Here is all of our equity before we get started, and then we will issue some common stock, preferred stock. We're going to buy some treasury stock, and we're going to pay dividends. All right, so, and then we're going to be putting those in. Okay, so let's go with selling. Let's see if we can calculate things that we need to here. So this is going to be A, and we're going to sell 150,000 shares of common stock. Okay, the selling price is $9 a share. Okay, so we got to calculate how much. So 150,000 times 9. $9. Okay, let's do the math here. Equals 150,000 times $9. Yep. Okay, so I need to change this to, and then I'm going to change all of these to dollars. Okay, so if you keep them in dollars, it helps. Okay, so then the par is up here is 5, right? $5 par. Okay, so then we take 150,000 times $5. 150,000. And then the excess is $4 a share. Yep, $4. So we'll take 150,000 times 4. Okay, 150,000 times 4. Times 4. Okay, so there it is. Okay, now let's do the entry for this. So this is going to be A. And we're going to get cash. So common stock. Okay, there's all the balances there. Let me get rid of this. Okay, we'll put A here. Okay, A. All right, that's going to be right here. So the amount coming in is 1,350,000. Okay, and then this is going to equal the amount we calculated here, 1,100,000, because that's the 150,000 times 5. And then the excess goes right here. Oh, no, it doesn't. It goes up here. It is common. Yeah, common. All right, so we want this to equal what we just calculated here. So now let's put this in. This is A. So I guess, what is the date? Oh, December 12th. All right. So December 31st, sorry, December 31st is the transaction date for all of these. So cash is coming in for 1,350,000, and common stock gets a credit for 1,100,000, and then we want paid in capital in excess of par common stock. We'll put this in. Okay, so this is going to be the 600,000. Hold on just a minute. Something is not right. Let me check. 150,000 times 4. Hold on. we're out of whack here. 150,000. There we go. There we go. There we go. Sorry about that. Let me, okay. So instead of this, oh, nope, that's good. It's this one that's the problem. Okay, so this is 750,000. Okay, and then that makes this be 600,000. Okay, let's check it. And I guess we have to wait. All right, so let's put in our next one. Now, I'm not quite done yet. I'm just putting in the next date. Here's what I want to do. We're going to keep a tally over what's going on. So one more time, the number of common shares that we started with is that are issued 3,950,000. Okay, and then we just issued 150,000. All right, and then, all right, so we want to make sure we keep track of that. All right, here comes the next one. Issued 14,000 shares of preferred 1% stock at 97. So let's go ahead. And this time we are selling 14,000. Okay, at a price of $97. Okay, so we want to take 14,000 shares times $97. Okay, so I believe, there we go. And then the par for that is 70. So $70 par. So that means the excess is $27. And we want this to be 14,000 times that $97. Okay, and then 14,000 times 70. Which is the par, and then the extra is the 27. So 14,000 times 27. Okay, so now I need to make sure all of this is, so if this is our debit, that's how much cash is coming in, then our credit needs to be 14,000 times $70. Yep, and then 14,000 times $27. Okay, and these are dollars here. Okay, those are the two. Okay, so now we're going to put this in. Oh, let me put this in up here. So we're going to do preferred. So this is going to be B. Okay, this equals what I just calculated right here. Okay, cash is going to come in. And this was A. And this is going to be B. Not balance, but just B. Okay, yep. So we need all of the money that we're selling the preferred shares for right there. Okay, let me get rid of, there we go, that's better. Okay, and then the offset goes to preferred. That's going to go here, equals the amount right here. All right, so we've got, so let's do cash. Cash is coming in for 1,358,000. And we've got preferred shares that we're selling, preferred stock, and it has 980,000 as a credit. And then we want paid in capital in excess of par. Paid in capital in excess of par for preferred. Okay, so that's going to get the extra which is the 378. All right, I think we're okay. Let's do December 31st again, and then read the next event. Okay, so down here for our, all right, I think we're going to purchase. Okay, we're going to purchase some of our own shares, I think is what's next. So let's read it. It said purchased 155 shares of Treasury Common for $15 a share. So you say, why would you do that? Why would you buy your own shares? Well, when we do this, right, when we issue these shares, both A and B, that is what they call the primary market. That is from the company out to the secondary market. That's the primary market, then entering the secondary market. Well, this company will never make money again on these shares once they've sold once. So they've made it possible for businesses to buy their own shares. They're called reacquired shares. So we're going to buy our own shares just like we were any other investor in the market, right? So we're going to buy them for $15 a share. So that's going to be treasury stock. So we're buying 155,000 shares. Okay, and we're buying common. Very rarely do you buy preferred. I've never heard of that, but we're buying preferred shares, okay, of treasury stock, and that's what it's going to be. So I'm going to put common stock, but this is going to be purchased treasury stock. All right, so we're buying ourselves at $15 a share. Okay, so we're going to decrease cash by 155,000 times 15. We're going to put that amount in the treasury stock account. So 15. 155,000 times $15. And then that will be the same amount for this one. But now we need, okay, so those will equal each other. We're going to create the treasury stock account. So we're going to debit the treasury stock account for the amount of 2,325,000. Okay, and that's the treasury stock, and that's how much cash was used to pay for it. Yep. All right, so let's go ahead and put it in. Okay, so we've got treasury stock. Now, most of our, our other stock accounts have a credit normal balance, but when we buy ourselves, we have to put it in a debit because we have to actually subtract that amount from our common stock. So I'll show you what I mean here. So let's get rid of those. All right, so let's go ahead and finish this. So then cash is going to go down for the amount for buying those shares. Okay, now above the treasury stock account, I am going to put the amount we paid for them. So $15 is its cost. And once again, we bought 155,000 shares. Yep. Okay, so that goes with that. Now over here, sorry, it must be up here. Yeah, up here. We forgot we issued. So we issued 14,000 shares there of the preferred. Now we're buying treasury stock. We aren't going to mess with preferred anymore, I don't think, but we're going to buy treasury shares. So we're going to subtract the amount of shares we're buying from the common shares, because Now we have an amount outstanding, number of shares outstanding. So I told you, as long as we didn't have treasury stock, our amount we've sold, which is issued, equals our outstanding. Okay, but now that we have bought some treasury stock, we can't count that as when we're looking at outstanding. Outstanding is different than issued. Issued means we sold it once. Okay, we sold it once in the primary market. But then now that we're looking at the secondary market where investors buy and sell shares, it's the shares that are outstanding because they're in the secondary market. Okay, so I think we've put them in now. And what do we hope happens with this treasury stock that we bought for $15 a share? We hope that it sells for more than that. Okay, so let's put a date in. Okay, and get to reading here. All right, so now we're going to read that we sold 120 of those shares, see, at a value that was higher than what we paid for them. So now let's go down here and figure this out. So now we're going to sell treasury stock. Okay, so once again, common shares and selling preferred shares for cash. Whoops. And now we're going to purchase, we bought the purchase, we purchased the treasury stock. Now we're going to sell some treasury stock. Okay, so we bought 100, nope, we bought, oh, nope, now we're selling. Yep, we're selling 120,000 shares of the treasury stock. Okay, and we're selling it for $17 a share. We paid $15. So we're going to have some extra from the sale of treasury stock. All right, so once again, we got to go with how many we sold. 120 sold at 17. Okay, so 120,000 shares of treasury stock times 17. That's the increase in cash. And then we want 120,000 shares at what it cost us, which was 15. And then 120,000 shares times the $2 extra we're bringing in. Okay, so, and that's from the sale, paid in capital from the sale of treasury stock. So let me put this in and I will explain it. Okay, so now we have 120,000 shares times $15. Okay, and then 120,000 shares for $2 times 2. There we have it. Okay. By the way, this is paid in capital from sale of treasury stock. Okay, so we should have, yep. All right, so let's go back. So now we've sold some of this. So the amount that's going down, okay, let's go with the cash first. Okay, let's go with the cash first. So cash is coming in, and this is D. Yep, D. So we're selling, and it equals this amount right here. And then the treasury stock is going to go here. Okay, and that was C for there. And this is C for treasury stock. Okay, and then, okay, so here, so we want treasury stock to go down by the amount that we sold, which is right here. And then the paid in capital in excess from sale of treasury stock right there. All right, so then this is going to be C. Okay, so this is December 31st. So here comes the cash. The cash is $2,040,000. Okay, and treasury stock will go down because we're selling it. Okay, but we can only subtract it based on its cost. Okay, so let me put treasury stock. And then we want paid in capital from sale of treasury stock. So there's basically 3 paid in capitals. There's paid in capital in excess of par. There's paid in capital in excess of preferred stock. Paid in capital in excess of par for common stock. Paid in capital in excess of par for preferred shares, and then paid in capital from sale of treasury stock. Okay, so this is 240,000. All right, so now we had 155,000 shares, right? And we just sold 120,000. So I am going to put here equals 155,000 minus 120,000. I'm gonna get rid of the CS. So here's how many we have remaining. 35,000 shares. It's making up of what this is. Okay, let's put our date in, December 31st. Okay, so now let's go over here and keep our amounts figured out. So when you sell it, it comes back, all right? It comes back into outstanding. Okay, so that's 120,000. So it comes back into outstanding. And now I think the next one is another sale. So then this becomes E. 60,000, sold 60,000 shares of the treasury stock for $14 a share. All right, so let's go down here and figure out what's going on. Okay, so we're going to sell treasury stock again. And we're selling 60,000 shares. And by the way, I'll put treasury stock here. That came from common stock. We're selling them at $14 a share. So we've got 60,000 times 14. Okay, so that's how much cash is going to go up, equals 60,000 times 14. Okay, and then we purchased these shares for $15 each. So this wasn't exactly ideal. Okay, because we're actually losing some money. Okay, so we've got equals 60,000 times 15. And then the difference, right? The difference is $1 loss. So we have $1 loss per treasury share. Okay, there's $1 difference. So 60,000 times $1 is 60,000. So 60,000 times $1. There it is. Okay, so here comes this entry. Cash again, because we're selling. Oh, let me go up here. So we had the, what? What? Okay, just a minute here. I got to make sure. Well, we only purchased 155,000 shares. And they're telling us that they're selling 180. So, you can't sell more treasury shares than you purchased. We don't have treasury shares to begin with, so there's not any in the beginning balance. Boy, they didn't do very well here. Let's, well, like I said, you can't sell shares you don't have. So let me see what we got. So we know it's going to be cash, and let's try this paid in capital in excess of par. It's going to be next because we're going to need to make that paid in capital from sale of treasury stock go down. So then the last one is treasury stock. So I don't know whether to go. I'm going to put 35,000 because that's all we have left. We had 155,000. If you subtract 120,000, you only have 35,000 shares left. So I'm going to see what happens here. And if it isn't right, then I don't know. I haven't seen that happen very often from Cengage. Usually Cengage is on it, but okay. And then wow, unless I'm missing something. So I haven't seen it yet, and the difference is the $1. Okay, so I only show 35,000 shares left to sell. So 35,000 times 14, and then 35,000 times 15. So that would mean that we would be empty up here. So here's how, see, there's only 525,000. So to make that sale, and then there would be no treasury shares left. There it is. And cash is coming in for that sale. Okay, that's fine. The sale from that one. Okay, and then we want this. Okay, this is going to be E. Okay, so we actually will use this 35,000 as a debit. Okay, as a debit. I hope that's what they are going to show, because I'm still confused. So now we have, so 155 minus 120 minus 35,000 is 0. Okay, I just want to make sure one more time. Purchased 155,000, then we sold 120, then we sold 60. So that is 180. So they're off. Okay, so I'm going to put this in. I don't know whether we're going to be right or not, but this is how it would work as far as I know. Okay, cash is going to come in, paid in capital, 525,000, and then boop, 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 that goes to treasury stock. That's all that's left of treasury stock. Paid in capital from sale of treasury stock, 35,000. Let's see. Okay, I think it's right. I think this is just wrong words. They forgot to fix this. So when they take 120, you need to cross out, make sure yours adds up. Okay, you're going to sell however many's here, and then however many remains is all you can do. Okay, so I've got those in, and then I want to go over here to account for them over here in what we're doing. So we're selling 35,000. So the outstanding Okay, outstanding common stock. So we bought some. And now we're back where we were, right? We bought treasury stock. We made a little extra money, paid a capital, 240,000, but then we lost some. Okay, now we're going to look at sending out dividends. Okay, sending out a dividend. Okay, so then it says declared cash dividend of 50 cents for a preferred share, which I thought it was supposed to be 1 times. I thought it was supposed to be, well, I think they forgot. Oh my goodness. Okay, 50 cents a share. Okay, well, that's what they're sending. I thought they were supposed to get 70 cents, but that's all right. And then 6 cents a share. Whoopee. All right, so here's the dividend for common. And this is how many shares are outstanding. So 0.06. So that's 246,000. Okay, so our outstanding shares for preferred are 96,000, and they're saying 50 cents when it told us that, okay, there's the total dividends going out, 294,000 if we use the 50 cents. If that 50 cents turns out to be wrong, it should be 70 cents. So, wow. Okay, so let's declare. Okay, so let's declare. So we've got 2 amounts to declare. All right, so when you declare it, you're going to put it in this cash dividend account. So cash dividends. Okay, and that is going to go in as a debit. So I believe the total is 294,000. I just don't know whether to go with the 50 cents. I'll know soon enough. 294,000. Okay, and that's going to go to a cash dividends payable. So here's where we're at. 294,000, and it's going to go in the payable. Okay, until it is paid, and they need a little time between. Okay, so there's the declaration date, which is what we're doing right now. And they need a little time to find out who owns the stock. Dividends payable for 294,000. And then we're going to pay it. Okay, then we're going to pay it. So then cash dividends. So this is, what's up here? F and G. Okay, so this is F to declare the dividends. Okay, and F. Okay, and then G. F. Okay, and then G is going to make this go down. So when we pay them out, we'll pay them out in cash. So G. Okay, so once again, we don't know for sure if this is right. We may have to change it to 70 cents, but okay, so cash dividends payable gets the debit. And then the cash goes down by that amount, by what they're saying. Now, if this is wrong, we'll go fix it and see if that one will work. Okay, so, and hope. They just didn't follow through with the numbers that they made changes for. All right, let's check the work. I don't know. Okay. Well, okay, those amounts are wrong. So let's see if I can figure out how to make it right. So maybe they did the math based on this, even though they really don't have. All right, so let's go put that in. All right, so back to this part. Okay, so they're saying they have 60,000 shares. I just don't think they paid attention. So let's see if this is right. And we'll just see if this fixes it. Okay, so then we've got 840,000, which doesn't work. Okay, 840,000. So see how it has a wonky balance now? Yep. All right, so then this is going to be that. So, oh, I haven't finished it out here now. So then 60,000 times 15. Nope, that's all right. Let me start over. Okay, here's where we sit. All right, here comes the cash. Let's get the cash of 900,000. Okay, so then treasury stock is going to go down by 840, and then the paid in capital has got to go on this side right here because we sold it at a loss. Okay, we sold it at a loss, and I need to calculate. So this should be 60,000. There it is. There it is. Okay, so now let's put this in and see if it's correct. So we got 800. Okay, where are we? Okay, 840,000 in. All right, and then we got 60,000, making the paid in capital from, okay, and then treasury stock goes down by 900,000, which wasn't in there. Yeah, I got these wrong. Hang on one more time. Okay, so the amount we received for selling it at $14 each, and then 900 down in, there we go. So then this has to be treasury stock because it's, let's see if this is right. Yep, but they didn't buy enough, so this is not good. I guess this should have said bought 180,000 shares, but C is right. Unless they had and they don't show a beginning balance, so it wasn't sitting there. All right, so now we're going to declare the dividend. Okay, so we've got over here. Oop. So we got to go up here and fix this. So 60,000. I don't know how that's supposed to work. But anyway, something's wonky. I need to turn this in. So now cash dividends should be, if I got it right, and it's 50 cents, so 295, 500. Okay, so 295, 500. Let's check it. Yes, and then that same amount. So they just didn't follow. So that this needs to be turned in, but there you have it. Okay, there you have it. And if you needed to look at it from this, once again, it was 50 cents. And for 48,000 and this is 6 cents. Yeah, 6 cents. Yep, there it is. There it is. So we got it. We got it. Okay, that's it. Wow. Okay, I need to turn that into Cengage and tell them that they've got it wrong. So I will see what I can do. All right, that's it. I will say goodbye and we will see you on the next video. Okay, put this down. Stop my share and we will stop the recording. So see you on the next video. Keep up the hard work.